this is Strictly Money, and I'm your host, Saijal Patel. Thanks for joining. Imagine that you file your tax return and claim what you believe are legitimate home expenses, costs you incurred while being forced to work at home during the pandemic. Then imagine that Canada Revenue Agency denies 100% of your expenses. Not 25%, not 50%, but all of it, even after you've provided more information at their request. Frustrating, no? Well, stories like this are becoming more common, and there's a growing discontent with how the CRA is operating. Many are describing the agency as unreasonable, even predatory. Tim Cestnick is co-founder and CEO of Our Family Office, and he believes it's high time the culture at the CRA gets a complete overhaul. Hi, Tim. Great to have you on.
Hi, Saijal. How are you?
Good, good. You know, Tim, you deal with the CRA regularly. You support clients who deal with the CRA, and I know you've written a lot about this. You don't feel, as a whole, that they're acting reasonably or fairly. Why?
Well, first, I just want to say that the reality is there are some really good people at CRA. There's some people on the front lines who are trying to be helpful. You call them up, they'll do their best to try to help you out. But if your file gets to the point where they are actually auditing you or requesting more information, it just seems like these days, as compared to a few years ago, the requirements that we have to of what we have to provide to CRA just to try to get some basic deductions that we should be entitled to is becoming really onerous. The example you gave is a good one. Home office expenses. So many of us worked from home over the pandemic and still work from home. And what we're finding is that CRA is now auditing a lot of those claims, those home office claims. And that's understandable because not everyone should be entitled to those claims. But when you provide reasonable information, sufficient, what most people believe is sufficient information, and they still deny the expenses, it gets to be very frustrating and very, very time consuming. And really, there needs to be a balance between how much time and effort it takes to justify your deductions and the amount of money CRA hopes to save or collect in taxes if you don't get the deduction. There needs to be some symmetry there, and there really isn't. It seems like even for small deductions, they're going to great lengths to force people to spend a lot of hours trying to justify them.
Yeah, Tim, I think you make a point. We're not talking about tax cheats here, because there are some who do that. We're talking about people who legitimately are trying to do the best.
Yeah, that's right. I mean, people who are going to cheat in their taxes, they're going to get what they deserve. But people who are being very honest and are just claiming that they're entitled to claim shouldn't have to jump through hoops to get their deductions. Then that's what we're finding is happening, not just with these kinds of deductions, home office expenses, for example, but many other things. So it's more of a cultural thing at CRA at this point.
Yeah. So it's interesting because they do have this taxpayer bill of rights, and I took a look at it. So there's about 16 listed, and there's things like you have the right to privacy and confidentiality. You have the right to service in both official languages, fair enough. But I also saw that there's ones like you have the right to complete, accurate, clear, and timely information, and you have the right to expect us to be accountable. And those are the ones, it doesn't sound like they're meeting those.
I think there are a number of those rights that are not being met. And the problem with the Taxpayer Bill of Rights is it doesn't have any teeth. It's not actually a piece of law that CRA has to abide by. And taxpayers don't have a right to take CRA to court because they didn't live up to those particular Bill of Rights, which again is not really a set of rights. It's more of
a mission statement.
It's more of a set of aspirations, I think, on CRA's part. Yeah.
Okay. You mentioned, we have about a minute till the break. You mentioned one example, as I mentioned, the home expenses. What other things are you seeing that are being denied?
Well, I think, there are examples, and I've written about this recently in the Globe and Mail, where tax battles with CRA have gone on for 20 years, over 20 years, and there's still no end in sight to a couple of these. I mean, that's just not acceptable. If in one particular case, the taxpayers claimed certain deductions for an investment they made, and they received approval ahead of time from CRA for this kind of investment to be made, and yet CRA still denied them, and they've been battling for 20 years, and there's no end in sight to that. That's just not acceptable. And there's other stories where CRA has been slapped on the wrist by the Tax Court of Canada for, being unfair to taxpayers. And so I think it's a cultural thing. It's not sort of at the frontline staff level at CRA. It's really more the managers, senior managers, senior managers, people you don't really see who are calling the shots on how people should be assessed. And I think that culture needs to change.
Yeah, usually it starts from the top. As we know, culture always starts from the top. All right, we're going to take a quick break. We'll be right back. Welcome back. Tim, so what is the process of appealing so our viewers understand, and what would you say is considered to be reasonable?
So when you file a tax return, that begins the process of the processing process, if you will. So you send your tax return to the government. They will process it, and they will send you what's called a notice of assessment. That's basically a letter, or now it's electronic usually. That's an email that simply says, we received your tax return, we've processed it. At that point in time, they may actually ask for more information, but usually not at that point. Usually within a month or 2 or 3, you might get another letter from them. If they have any questions or concerns about your tax filings, they may, for example, ask to see copies of donation receipts or medical expenses, because after all, most people are filing electronically now, so they're not sending that paperwork in. So that's not what we call an audit. That's just simply a review, and it's a request for information. Nothing wrong with that. But where it becomes problematic is where you do provide legitimate information to CRA to substantiate or prove your deductions or credits or whatever you're claiming, and then they deny them. If they deny them, you have the next step in the process is to get on a phone call and have a conversation with them, see if you can resolve it by phone, which you probably won't be able to. And so what you'll end up having to do most likely is file what's called a notice of objection. A notice of objection basically says, okay, I sent in my return, CRA reassessed me, they didn't like certain things, now I'm objecting. You file a notice of objection. If you get to that stage, I would highly recommend that you call a tax professional, a CPA or a lawyer that specializes in tax, because your notice of objection should be prepared at a very, taking into account things like tax law references and court cases and things like that, just to make sure you've covered your rationale. Why are you claiming this deduction? So anyway, you've got to file a notice of objection. The problem with that is, of course, now you have to wait probably anywhere from 6 months to 2 years here, and quite often it's well over a year. And what some people will do is they'll file a notice of objection, and if it goes on long enough and you still don't hear back from them, or if you don't like their answer to your notice of objection, you have one other approach, and that is you can file what's called a notice of appeal. Now that is a request to go to court. So unfortunately, it may cost you money in terms of legal fees. Some smaller cases, if it's under about $15,000 of taxes payable, that's what you're talking about, you can represent yourself at court. That's called the informal procedure. But if it's a higher dollar amount, you're going to need a lawyer to represent you. That's where it starts getting really costly. Yeah. And my concern, Saijal, is that what's happening is, in many cases now, CRA is just simply denying expenses, even though evidence has been provided, proof's been provided. They're denying these things too often and forcing taxpayers to have to file a notice of appeal. And that gets to be costly, where a lot of people are just say, you know what, it's not worth fighting it. Not going to pay the cost. And so they abandon the idea of fighting it, and CRA keeps the tax. And that's just not a right approach it's not an unethical approach to reassessing taxpayers.
No, exactly, because you're putting a lot of burden on the individual who probably is not in the position to fight it. Tim, what would you like to see? What do you think would help the problem? Is it training? Is it, consistency? What is it?
I think CRA needs to give probably better training to some of their frontline people, and give some of those frontline people or people closer to the front line who are dealing with taxpayers day to day, give them more authority to make some decisions based on reasonableness. So, we want CRA to be reasonable. And, if they're going to insist on objecting or denying everything, that's going to just continually be a more expensive way for taxpayers to live. And it's not. So it used to be that you could reason or have discussions with the frontline people, and they had the authority to allow or deny your expenses. And it seems like now they're not given that authority. They're just told to blanket deny and let people file objections and appeals, where more senior people at CRA will look at them
Yeah, yeah. We only have 45 seconds. I did note that someone commented on your Globe and Mail article that there used to be a time when you could speak to someone actually in person. And I think that's important, right? Because it gives context. You have that face-to-face interaction. That doesn't happen as much anymore, does it?
Well, it certainly doesn't happen face to face, except in very rare situations where you're, in a big battle with CRA and you're being audited. But if you're just, addressing a request for information, you can get people on the phone and have a conversation that way, but you won't see them face to face. But I still think that's probably okay, just having the phone call. You just want them to be reasonable with the response they provide.
Yeah, well, it's certainly a start. All right. We're going to take another break, Tim. And when we come back, I want to get your advice on what people should watch for when dealing with the CRA. We'll be right back. Welcome back to Strictly Money. I'm here with Tim Cestnick of Our Family Office. Tim, so when people are dealing with the CRA, knowing that this could be a possibility, could get dragged on, what's your advice?
So I would suggest, first of all, you try to solve any issues you have by having a phone call with somebody at CRA. See if they'll resolve the matter there. If that doesn't work, then you may have to file a notice of objection, and that's really where you need to get professional help, I would suggest. The best thing, of course, Saijal, is to avoid run-ins with the CRA altogether. How do you do that? Well, first of all, be honest with your tax filings. Don't claim expenses and deductions you're not entitled to claim. That should go without saying, but I'll mention it. Be honest. Next, make sure you keep all of your paperwork, all your receipts, all your supporting documents that support your deductions, your credits, your income, because CRA may ask for it. And if they do, you want to have it handy. And there are maybe gray areas too, where maybe you're claiming something that is, like, for example, maybe you're self-employed and you're claiming a deduction for something that is kind of a gray area. And, an example of that might be where something's partly personal use, but partly business use, depending on your job or your work,
Like car expenses, maybe?
Car expenses may be deductible, yes. And so, but where you've got gray areas, you want to be careful. And I'm not suggesting you don't claim those things. You should if they're legitimate, but just be prepared that you may end up having to discuss them with CRA and may get into a much longer conversation and may get reassessed if they don't like your explanations for things. So, understand what those gray areas are. And by the way, there are certain industries that get audited regularly as well.
I was going to ask you, what triggers a possible audit and what professions really have to watch for this?
Well, every year the list of deductions kind of changes, but people who are in the food services business, if you're a waiter or a waitress, unfortunately, you're probably being audited regularly or periodically. The construction industry, cash types of industries get audited quite often, so be aware of that. Also, they tend to focus on certain deductions from year to year, so sometimes it's childcare expenses, sometimes it's charitable donations. It can be moving expenses one year. But when you claim deductions that may be unusual, that you don't claim routinely, just be prepared maybe for questions and make sure you have answers to why you claim those things.
Okay. I want to circle back just really quickly and just, we know that there's cultural problems and it usually starts at the top, as you said, and frontline staff is often powerless. I'm wondering, are you as a tax practitioner being heard? Is this something that maybe MPs need to pay attention to on behalf of their constituents? How do we change this?
It's going to be like turning a very large ship because this is not something that's just changed in the last year or two. It's been a slow change over the last 15 to 20 years. This cultural shift. I do think that as tax practitioners, we need to be more vocal with the CRA about what we think is acceptable, what's not acceptable. Taxpayers need to be more vocal with their MPs. And just say, look, here's what I'm dealing with. This is not fair. If you feel like you've been treated unfairly, let your MP know. There's also a taxpayer ombudsman. I've never dealt with them. I don't know how effective they are. I've heard that they're not necessarily an effective organization. I mean, they all ultimately report to the Minister of National Revenue, who heads up the CRA. So I'm not sure that, I don't know how effective that will be, but there is an ombudsman you can contact to share your concerns as well. I think you need to, not just say nothing. You need to voice your concerns to MPs, ombudsman, and to CRA itself. And, And hopefully that over time may bring about some change.
Okay. We have about a minute to our next break. I want to switch gears, Tim, because you do provide real tax advice to our viewers. The economy is pretty shaky. Stock markets are down, but I always say never waste a good opportunity, and saving taxes is one of them. Can you explain tax loss selling and how investors can use that? Because I think that's a really key one that we should look at.
For sure, for sure. As we head towards the end of the year, you want to think about what things you might do before year end to save yourself tax for this year. One of those things would be tax loss selling or tax loss harvesting, which is taking some investments that you might have that have dropped in value and potentially selling them before the year end. That's going to trigger a capital loss, which you can then offset against capital gains that you've realized either this year or in one of the 3 prior years as well. So if you paid tax last year or the year before on some capital gains and you've got capital losses this year, you might be able to recover some taxes that were paid in the past. That's a pretty nice thing to get back, is a nice refund. So keep that in mind. And there's some other things that we want to talk about related to losses as well. But that's the first place to start, is look at what's in your portfolio, what's declined in value. Should you sell it before year end?
Okay, and I should remind people this is typically for non-registered investments, right? Where you're taxable. Okay, we're going to take a quick break and we'll be back again. Welcome back. And Tim, just before the commercial break, we were talking about tax loss selling, or sometimes it's called harvesting. What do investors need to be mindful of so they're not caught offside? Because I know there's some rules they have to follow.
Yeah, for example, if you sell something at a loss because you want to claim the loss, but you really like the investment, so you decide to buy it back again, make sure you wait 30 days. You can't just sell something and then buy it back the next day and hope to claim your loss. That loss will get denied. So make sure you do wait 30 days. I think something else that you might want to keep in mind is that there are ways to trigger losses and do other planning at the same time. For example, you could take an investment that's dropped in value and you could gift it to one of your children, as an example. And what that does is it triggers the loss in your hands, but also makes a gift to the child. Your child can keep the investment, or they can sell it and reinvest the money, whatever they want to do. So help them if they're trying to save for a down payment on a home or something else. So that's something you might want to think about. Or similarly, if you take an investment that's dropped in value, you may want to consider donating it to a charity. Maybe the charity can use the money. They would sell the investment and take the cash and do whatever they'll do with it. But you get the loss when you donate a security to charity like that. So that's also something to think about. Beware, though, if you happen to take an investment that's dropped in value and you just transfer it to your RSP, for example, or transfer it to a TFSA in kind, your loss will get denied in that situation. So,
oh, really? Okay.
Yeah,
so I have seen strategies where it'll be in their RSP, they like the investment, so they'll sell it and then want to transfer or buy back in a TFSA. Is that okay? You can't actually transfer directly.
No, if you transfer it, the loss will get denied. But if you sell it and then buy it back inside your RSP or TFSA, the loss will also be denied unless you waited 30 days. So make sure you do wait that period of time.
Oh, very interesting. Speaking of charitable giving, we are near the holiday season. It's typically when a lot of people think about donating, but also for year end because they can get the receipts. Any advice?
Yeah, I would encourage people to be strategic about their giving. Don't just wait until December to make all your charitable gifts every year. Give throughout the year. Sort of decide ahead of time. Think of your giving like an investment asset allocation. Think about a giving allocation. What causes are important to you? And maybe it's 2 or 3 different types of causes: healthcare, child welfare, whatever it is. And then find charities within those niches that you really like. So it's really like an investment decision as much as it is a giving decision, and do it throughout the year, not just in December.
Okay. Can you remind us too what the deductions are like, and does it make sense to pile up, not claim all your charitable donations in one year? How does that work?
You can claim up to 75% of your income in any year in donations. So that's a lot of donations. But it does usually make sense to pile them onto one spouse's tax return if you're married. That does make sense. And I think, you're going to save probably about, it depends what province you live in, but about 50 cents on the dollar for every dollar you donate. So the government's really participating in this with you. They're giving with you by giving you back tax savings. So keep that in mind. Every dollar you give up, you're probably keeping 50 cents for yourself, and you're giving 50 cents away. That's really how it works.
Okay. We only have about 45 seconds left. Any last minute tips for those who are planning just for the year end?
Yeah, I think there's one other thing I'll just mention here. I've written articles in the Globe and Mail before about transferring capital losses. It is possible if you've got an investment that's dropped in value but you have no capital gains to offset the losses. It's possible to transfer your losses to a spouse. It's a very simple thing to do. I won't get into the steps on this in this show because we haven't got time, but take a look at that online. Transferring capital losses to your spouse can be done as long as you haven't sold the investment yet. The investment's still in your hands and it's dropped in value. You could transfer that loss to a spouse who might be able to use that capital loss more than you can.
Okay, Tim, really appreciate your insights today. I'd love to have you back.
Sure, glad to do it.
Okay, that was Tim Cestnick of Our Family Office. Well, that does it for this show. November is Financial Literacy Month here in Canada. And with high inflation and so much economic uncertainty, it's more important than ever to learn how to manage your money. That's why I created this show, so I can discuss the financial issues that matter most to you. I encourage all of you to build your financial literacy. There are tons of resources out there. You can even visit my website, saijal.com, or write to me and let me know what you'd like to learn. Thanks for watching. I'll see you next time.